$30. That's all it costs to own a piece of one of the most powerful drug companies on the planet. But here's the thing. Most investors won't touch it right now. That's exactly why you should be paying attention. Pfizer. The name alone used to make investors drool. COVID vaccine. It's billions in revenue. Stock flying. And then nothing. The stock collapsed. The narrative flipped. And right now, PFE is sitting under $26, levels we haven't seen in over a decade. So the question isn't whether Pfizer has problems. It does. The real question is, are those problems already priced in? Let's talk about what's actually happening here, because this is more nuanced than most people are covering. First, the bad news. Pfizer is heading into what Wall Street calls a patent cliff. Some biggest revenue generators are losing exclusivity. Liquis, one of their best-selling blood thinners, is going off patent. That means cheaper, generic versions will flood the market. Revenue will drop. Margins will compress. Management has basically told us this pain continues through 2028. That's not a rumor. But here's where it gets interesting. The market already knows this. Every analyst on Wall Street knows about the patent cliff, which means all of that bad news. It's already reflected in the stock price. The question is, what happens after? Think about it this way. You're not buying Pfizer for 2025. You're buying the version that survives the storm. This is a company with 175 years of history. They've navigated world wars, recessions, healthcare crises, and they're still here right now. Pfizer's dividend yield is sitting close to 7%. 7%. That's your cash flow while you wait. The Seagen deal, minus $43 billion, brought them into oncology in a massive way. Cancer treatment is a fast-growing sector. Their pipeline isn't empty. It's deep with candidates across oncology, immunology, and rare diseases. If these pan out, the story changes. The best time to study a company is when the crowd has stopped watching right now. Nobody wants to talk about Pfizer. Let's be real about the bear case. If the pipeline disappoints or competition is fiercer, then this stock has further to fall. There's also the question of debt. The Seagen acquisition wasn't cheap. Rising interest costs is a dangerous combination. So how do you actually play this? Think in thirds. Put 1/3 in now to establish a cost basis and collect dividends. If it falls further below $20, that's where you get aggressive. This is dollar cost averaging with intention. It's not panic. Watch the $24 level as your key technical line. Pfizer can hold above $24 and build momentum. That's your signal. Healthcare is not a sector that disappears. People will always need medicine. Cancer doesn't pause for market cycles. An aging global population means pharmaceutical demand will structurally grow for the next 30 years. The crowd abandoned Pfizer. The dividend is still running. The scientists are still showing up to work every day. Is Pfizer a guaranteed win? Nothing is. But is it a deeply discounted dividend-paying blue chip? Absolutely. If Pfizer's on your watch list now, drop it in the comments. Let's talk about it.